Hey guys, Sam with Sam on Real Estate and Finance here. And in this video, I'm going to talk about how an adjustable mortgage rate gets calculated. But before I get started, please make sure you like and subscribe to this video. It really helps me out with the YouTube algorithm. All right, let's begin. So, adjustable rate mortgages are now becoming a little bit popular because we're seeing those rates a little bit coming in a little bit lower than the 30-year fixed. But a lot of people don't understand how these ARM loans work and how they get calculated. So I'm going to explain how these adjustable rate mortgages are calculated. So there are two parts to the ARM rate. You have the index and you have the margin. So you can see down here, you have the index and the margin, and both of these combined give you your fully indexed rate. Now, your index is usually tracked or tied to one of the three indexes: the 1-year Treasury, the cost of funds index, or the LIBOR, which is the London Interbank Offered Rate. So your index is going to be tied to one of these indices. So this rate is never constant. It's always changing because it's tied to these indexes. So I'm going to show you, I pulled up the 1-year Treasury. So let's just say your arm is tied to the 1-year Treasury. And I have a chart here that shows the 1-year Treasury and currently where it is now. So today is June 17th. And right now, the value of the 1-year Treasury is at 2.86. Now you can see over the period of time that this rate has changed daily and it's not constant. It's always going up. As you can see here, at one point it was 3.15 and it went back down to 2.93. So it's always in a state of fluctuation. It's always changing. And you can see during COVID at one time, these rates were below 1%, but now they're sky high and people are looking for ways to have a lower interest rate and they're looking to ARMs to do that. So part of the adjustable rate mortgage is tied to one of these indices, and one of them being the 1-year Treasury. And you can look at this chart and you can see where the 1-year Treasuries are at on a daily basis. So going back to our little article here, this is how the indexes are calculated, or this is how they get the index. Now, your margin is what is provided by the lender. This is what the lender charges you. So the lender will charge you their margin and they'll add it to the current index. And that's where you get your fully indexed rate. Your fully indexed rate is an important number because this determines the size of your monthly payments. This is what the total amount of interest you'll be paying over time. And typically your margin does not change. Your margin is what is going to remain constant over the life of the loan. So your lender should be able to provide this information for you. They should be able to tell you what the index and margin is, how it was calculated, what the caps are. So meaning it shouldn't be able to go over a certain amount. It should be capped at a certain number. And these are some of the features of having an ARM. Now, how do the lenders come with this margin? How do they come up with that number? Well, there's a couple of things. I have another article here, and I'll have these links in the description below. But there's some factors that will determine your interest rate. Obviously, your credit score. The higher your credit score, the lower your rate it will be, right? Credit history. So lenders want to see that you have the ability to repay and repay on time. So the less risky you are, the better your rate will be. They also want to look at employment type. So if you're self-employed, some lenders may see that as a risk because your income may fluctuate versus being a W-2 where you know you're going to get steady pay every 2 weeks or monthly. The loan size is a factor, loan to value, the loan type, the length of term, your payment frequency, property type. So are you going to be in a residential home where you're going to be living in the property, or an investment property? Investment properties typically come with a higher interest rate because it's considered a risk type of asset. Co-borrowers, debt to income ratio. So is the amount of debt you have, is it over or more than what you're bringing in as far as income that can cover that debt? So they look for a certain ratio. And if you're over that ratio, then you may be considered high risk and your rate may be higher as a result of that. And then the documentation available, tax statements, bank statements, things like that. So these are the things that will factor in to your lender figuring out what your margin is going to be. What premium are they going to charge you for that loan? and then combined with the index that's tied to one of these indices like the 1-year Treasury, this is where you'll get your fully indexed rate. So this is how it's calculated. And I'm going to just give you some examples here. So let's say mortgage A uses a 1-year Treasury index they use the 1-year Treasury index plus a 2% margin. So they're charging you a 2% margin. So, and mortgage company B uses a 1-year Treasury index plus a 3% margin. So in these scenarios, company A is offering you an ARM loan. Let's say the 1-year Treasury is at 2.25% plus the 2% margin. That calculates to a 4.25% initial ARM rate. And then company B, we said that they're using the Treasury index plus 3% margin. So we know that the Treasury index is 2.25%. And then the margin that they're charging is 3%. So your initial ARM loan would be 5.25%. So that's just a couple of examples of how the ARM loans are calculated. In another video, I'm going to show you how to use an ARM calculator and how to figure out what your payments are going to be like. Obviously, there are different types of ARM loans. You have a 7-year ARM, you have a 5-year ARM, you have a 10-year ARM. So we'll use that calculator and we'll show you what your payments will look like, what the payments will look like after it adjusts, and figure out how this can benefit you or how you can use this to your advantage. All right. So if you guys have any questions on how to calculate an ARM loan, please leave them in the comments below, and I'll see you guys on the next video.